Scotiabank missed second quarter earnings estimates as it set aside some more money for potentially bad loans. Let's get some more perspective on the results with Maoyuan Chen, equity analyst, financial services at Morningstar. Thanks for joining us today.
Thank you for having me today.
What's your take on Scotia putting aside money or more money for bad loans? Was it warranted?
So in terms of this quarter's provisioning expense increase, I think it's slightly ahead of consensus, which is driving the earnings miss today. Because last week, Toronto Dominion has reported, and the provisioning increase is not as large as Scotiabank that's reported today. And moreover, Scotiabank has also increased its full-year credit provision expense guidance because it now sees more uncertainty related to tariffs, while Toronto Dominion has held its credit guidance unchanged, and it still expects its credit provisioning to improve in later half of 2025. So yeah, definitely Scotiabank's provisioning was a bit worse than Toronto Dominion, but that's so far the only two banks that has reported a cycle. So we will be looking for more updates from the four remaining banks that's set to report tomorrow and on Thursday.
Can you expand a little bit more on why Scotia or what Scotia is seeing and why they've decided to go this route?
Yeah, so in terms of the provisioning increase, it's mostly related to the performing loan provisioning in its Canadian banking segment, or speak in another language, it is a provisioning that's for loans that's still doing good. Those loans are not going bad yet. And so in this way, a lot of the times, the increase in the performing loan increase is driven by a worsening economic projection. And if we look into the base rates projections that laid out by Scotiabank, it has now lowered its Canadian 2025 GDP growth and raised its unemployment forecast for this year. I think that's part of the reason why we're seeing a large increase in the Canadian performing loan increase this quarter.
We're also seeing them pull back from some of their international markets, focus more on Canada and the U.S. Is their decision to focus on these two markets a wise one, given the circumstances for where we are?
Yeah, so in terms of the capital allocation, after Scott Thompson took over as CEO in early 2023, Scotiabank has renewed its capital allocation priority in that it wants to focus more on Canada and then US and to a lesser extent Mexico. So I think in the past decade, what investors have been quite disappointed is that Scotiabank is prioritizing international growth over profitability and return, which has somewhat hurt the investors. So we think the current strategy is a better focus and is a better use of capital, particularly into the Canadian banking segment, because historically, Scotiabank has been putting more focus over its less profitable and more volatile international banking markets. We think the bank has lost some shares in its domestic market. And if we look across the different segments, the Canadian banking segment actually offers the highest return profile and the most stable return profile. So I think investors will be happy to see the bank having a large earning exposure to the Canadian segment. And in terms of the U.S. segments, Scotiabank has invested a small equity investment into KeyCorp. The deal is quite small, but we don't think that's going to move the needle in terms of significantly increasing the U.S. earning exposure for Scotiabank. But this opportunity will offer Scotiabank a great chance to learn more about the U.S. banking industry without significantly contribute a large portion of its capital. Yeah, so overall, I think the refreshed capital allocation strategy is a better and a more focused one than before.
How exposed is Scotiabank to the Canadian housing market compared to some of the other banks?
So in terms of the housing market exposure, because Scotiabank has more international banking exposure, the mortgage in the Canadian market does not take as large exposure as compared to Royal Bank of Canada or CIBC, but it do have like the other Canadian banks, a sizable amount of residential mortgages, and we are paying a close attention to the developing story here in one of the hottest markets, like say in Toronto or in Vancouver.
Can you also tell me what your outlook is for banks? As you mentioned, TD has already reported last week, Scotia today. We expect some of the others to report soon as well. So I'm just wondering what your take is forward looking.
So in terms of for the 4 banks that set to report tomorrow and on Wednesday, we're definitely going to see increases in provisioning. But what's more important is the bank analysis in terms of the Canadian economy trajectory and to a lesser extent, US economy trajectory, because oftentimes, like I mentioned before, a change into the GDP growth and unemployment rate is going to drive changes in performing loan provisioning, which is oftentimes hard to predict, but we think we are definitely going to see higher provisioning expenses, at least for this quarter and for the remaining time of this year.
Maoyuan Chen, thanks for joining us. Maoyuan is an equity analyst, financial services at Morningstar.